Hello everybody, and welcome back to the SUV Properties Podcast. My name is Caden Stanley. I'm joined here by broker Melanie Eden, and today we're here to talk about recourse versus non-recourse loans. In case you missed it, our last two episodes just aired, and we're going to be airing this third one on St. Patrick's Day, hence the green color. She planned ahead, I did not. Happy St. Patrick's Day to everybody out there. This is more of expertise in Melanie's department, so I guess we're going to kind of be learning together a little bit about recourse and non-recourse loans and the benefits if you're in a situation like this. So,
all right, excellent. Thanks, Caden. There are many different types of lending, but understanding all the fine, small words in your 1,200-page loan document that you're going to sign is understanding the difference between what is a recourse loan and a non-recourse loan. Recourse loans tend to be with A-paper banks. You are usually an LLC lender, and in the event of a default, the bank has the right to come back at you to pay for the difference in what they sold their property for. So an example of how a recourse loan works is, let's pretend you get yourself into a situation where you're in foreclosure, and the bank takes the property back from you. So the bank steps in and becomes the new owner of the property that you used to own. And they take it back, and they believe they lent to you at $100,000 on this loan. But the whole market has changed, and now the value of the building that they can sell it for is $80,000. Well, you now owe the bank $20,000. And because of the fine language that is in your loan documents on a recourse loan, you now owe the bank $20,000. And the bank will then take you to court, put a lien against any asset that you own until you pay the restitution of $20,000 to them.
yeah, garnishing wages, anything that does to get the money back.
Exactly. And you're not, you can file a bankruptcy with a recourse loan. Are you really ever going to get out of it? Typically not, because they've filed a lien against one of your assets. And if you have a home that was free and clear or with another lender, there's a second mortgage on that. When you refinance or you sell your home, you are going to end up paying the bank off because you signed the loan documents and it's a recourse loan and they have every right to do that to you. Now, the flip side, these are non-recourse loans. These are usually B-paper lenders, mortgage brokers, sell non-recourse loans. They're Freddie and Fannie Mae loans. So in the event of a default, there's no such thing as a free lunch. Did you ever hear that story?
I have not.
You've never heard that story?
I have not, no.
The bill always comes due. Bottom line is, just because someone takes you out for lunch and they're paying for it, at some point there's probably some sort of compensation where you're going to pay back that. I thought everybody knew what that meant. Alrighty. Anyway, so let's go through the same scenario again, but it's a non-recourse loan. So you have this $100,000 property, the bank has foreclosed on you, and they've lent to you at $100,000. They take it back from you, and now they're the owner of this property. And typically, if it's a Fannie or Freddie Mae loan, you probably have private mortgage insurance on it, so the bank gets paid out from the private mortgage insurance. And they usually don't negotiate on a loan modification with you. They just want the property, they want to collect from the insurance company, and they want to sell it because then they can make double the amount of money on that loan. But let's pretend there's no private mortgage insurance on it at this point. So the bank takes it back, they sell it for the same $80,000. But because it's non-recourse, the bank cannot come back at you for the $20,000 difference that you owe them. However, here's our no free lunch, all right? You now owe taxes on that $20,000. And the kicker is, right, it's considered income. That $20,000 was a gift from the bank to you. So who do you think you owe that money to?
Now you owe it in taxes. You owe it to the tax man.
You owe it to the IRS. So the bank is going to send you out a form that says, congratulations, we sold your house, you're no longer the owner. And you need to file this form when you do your taxes. And you owe tax on $20,000, which shakes out to be $4,800 if you're in a 24% tax bracket. So the higher tax bracket you're in, the more money that you owe. So if you look at the two loans and say, hey, on a recourse loan, I'm going to owe the bank 20 grand, or I'm going to owe $4,800 to the IRS, which is a better deal? Obviously only owing the $4,800, but the worst thing is getting yourself into a position where you're ending up being foreclosed upon.
And I know one big caveat too that we had kind of mentioned before this video was it's not also, like you said, your free lunch situation. You know, you can't just do this and then move on and keep doing it over and over again. Obviously, there's repercussions on your credit and other things like that, because otherwise people would say, why don't we just do this all the time?
Right. Well, once you file a foreclosure or a bankruptcy of any sort, you're pretty much done for 10 years. You used to be done for 5 years, and then it was 7 years. But if you have multiple foreclosures on your record and a bankruptcy, because there are two different things, as well as short sales is another issue where people say, well, I never really filed a foreclosure. Well, a short sale means that the bank took it back and they sold it for less money than you owed them. So it's still a foreclosure. They just didn't have to go through the legal documents. You signed off on it and said, here, take it, I'm done. You're going to ruin your credit, and it's going to take you years to rebuild that credit. So when you're structuring your loans as a real estate investor and you're getting involved in buying your properties, you want to have a nice blend between recourse loans and non-recourse loans. You can only do 10 non-recourse loans through the Freddie Fannie program. And so understanding what properties do I put in a loan type that is a non-recourse loan. You want to make sure that you have your higher risk properties with lower money that's in those properties. So you have less equity that's in the property, because in the event of a default, you're not losing your down payment money. And it was something maybe that was a little edgy for you to get into in the first place. So you want to have that out with a non-recourse loan. Things that you want to have with an A-paper lender, things you have lots of equity in. So when you're buying through your LLC and you're putting 20, 30, 40% down, you have a lot of skin in that game, you have a lot of money in that property. So the chances of you defaulting on that are very low.
Yeah, 100%. And I know one question that I had when we kind of got into researching and looking into this topic, or at least myself, was let's say you don't have a lot of risk, why would you not go with just a recourse loan? And I know one of the benefits, I guess I should say, or restructure that question, is the benefits of a recourse loan is maybe a little bit lower interest rates, a little bit less down payment. It's a little bit easier to get a recourse loan because there's a little bit less risk in terms of a lender's side, because they can just start to garnish your wages and get their money back.
From an investor standpoint or from an owner-occupant standpoint?
I guess either or. I guess, is there a difference between?
There is a difference between the two. When you are with a recourse lender and you're an owner-occupant, what you said is absolutely true. Because people typically don't default on something they're living in. With the recourse loans on a non-owner occupied property, you're still putting 25-30% down on those. So what you said doesn't really fall in line.
Because either way you're paying.
Either way you're paying, and if you're going to give it back to the bank, default, foreclosure, short sale, whatever the lingo is that you want to use about a property that you're no longer going to continue to own, you just got to pay attention to what am I going to owe either the tax man or the bank if I don't pay this off and someone else takes it from me in a forced fashion.
100%. And looking at loans, recourse versus non-recourse, is there anything else that you kind of wanted to cover when it comes to those?
That's a great question. What I would consider is if I was an owner-occupant and I was buying my first property, is I would want to make sure that I have a non-recourse loan, because that way, in the event I lose my job, I get sick, understanding how they can't come back at me for what I owe them is going to be very important to me. So the next step in the non-recourse transaction when I'm an owner-occupant, this does not affect investors at all. It's only as an owner-occupant that you can live in a place for about 4 years as an owner-occupant without making a payment on it, where it takes that length of time to get through the foreclosure process, roughly 2 years. And I shouldn't be saying this out loud, but I'm going to say it anyway. And if you file a bankruptcy the day before your court date for the foreclosure process, the bank must start all over again with their foreclosure process. So it's another 2 years. In that time frame, you can do what's called a loan modification and try to come to some sort of an agreement and make payments so you don't lose your house. But if your back is really up against the wall, you're really sick, you have no money, you lost your job, you've got a 4-year window where you can live in that house and not make a payment before the sheriff shows up and the moving vans and you're moved out onto the street. And they can only come back at you for the taxes. Most of the time, those loans have private mortgage insurance on them, so what you're going to owe the bank is tiny.
Very little, yeah. And not that you're recommending it, but if it's a situation that you're in.
It is a strategy. So understanding that there are strategies that are out there, that's why you work with people like us that know these strategies so that when the shit does hit the fan,
you're right.
We stay out of the way of it.
Yeah, exactly. Yeah.
We don't want to get hit.
Exactly, of course. So we appreciate you guys tuning in today, recourse versus non-recourse loans. Tune in next Friday where we're going to be taking a look out at a property that we are in the process of flipping, just about to close on the property, and take a look at all the ins and outs and pros and cons and fun aspects of flipping a house. We'll see you guys next week.